June the 20th. I am delighted to be joined by Kieran Gallagher, MD at Vitol Bahrain, Amar Abaidli, Director of Research at the Bahrain Center for Strategic and International and Energy Studies, and Yasar Al-Malki, Gulf Analyst at MEES. Thanks so much for joining us, gentlemen, this morning. Kieran, let me start with you. We had our survey result of our question up there a couple of minutes ago, which was a poll on what the average price of Brent will be for the year, and will it mirror the below $80 of the first half in the second half? And we had 60% of our audience yesterday saying yes, we will continue to see that as an average. So give us your take today as we almost start the second half of the year on whether you think the sentiment out there is that, and does that mean that OPEC has achieved its sort of floor price, if you like, of 70? Like we're below 80, but we're not going to be below 70.
Yeah, good morning. Good morning, Tyler. Good morning, all. I think largely, what you have seen over the last 2 or 3 months is some of the sort of analysts, your GS, your JP Morgan, your energy aspects, etc., constantly revising that price revision down for the second half of the year, or their sort of December 2023 projection, largely going southwards. Now, with that, it's like, okay, OPEC are taking quite significant steps to support the oil price, but your question is good. Is that to support $80? 3 or 4 months ago, you would say, well, that was to try and support $90. And so I think it's the day-to-day chatter, some of the economic headwinds we've seen, demand numbers we've seen would suggest that supporting 75 would be a sort of more apt target than supporting 80. But I think largely in the sort of day-to-day news, sub 80 certainly seems to be more acceptable now, but certainly north of 70.
Okay, and a lot of people are saying, OPEC has to accept sub 80 because of what's happening with oil, in terms of the impact of that price on so many emerging economies, impact of rising interest rates on so many economies, etc. It has to come out of the reality of we are facing perhaps a shallow recession in the West. And people are saying it's just trying to defend 70, really. That's what it's doing. It's not really trying to get back to 90. Yasar, good morning again.
Good morning.
The outlook for supply demand in the second half of the year now. We've had OPEC and the IEA give us their latest reports, which are quite bullish versus others. But given all the data we have coming out of China as well that we can get our hands on, and the forward sort of outlook, do you see a tighter situation in the second half, as everyone's been saying we should be expecting?
Well, it is. Thank you very much again, Diala. It is still a matter of looking at the data coming out of especially China. So on the upside, just looking at the past 2 months, we had record Chinese crude and condensate imports, around 12.17 million barrels per day. And that was in May, and that was the third highest since June 2022 and March of this year. The first 5 months of the year, we saw imports increasing 6% year on year. But at the same time, you look at stocks, and China is building massive stocks. Some of the news that you shared today on your bulletin also show that China is starting to export refined products, and that is a sign of further weakness. So the downside is building up. In addition to the stocks, you look at the stocks, and the stocks are very important. You look at May, you had around a build-up to 966 million barrels, and that was just within a small 20 million barrels touching distance of the record levels in 2020 and early 2021, when China built these stocks on cheap COVID crash oil prices. Now, weaker than expected overall China data, so especially imports and exports for May, and this is considered as an indication that the country's economy, in particular its manufacturing core, was underperforming expectations. You look at the manufacturing PMI after increases, through January to March, you are seeing a dipping in April and then in May for the second time of the year. there are worries that the construction sector may soften further amidst lacking clarification on recent Chinese government economic measures, including cutting rates and so on. The question that really we need to ask, because China is very important, you look at what the IEA has expected in terms of, the overall demand picture for 2022, and also OPEC, they see above 2 million barrels per day of demand growth for 2023, but 60% of that is coming from China. The question that we really need to ask ourselves is how much of that, strong economic rebound that we had in China in the first half of the year is actually pent up demand after abolishing the zero COVID policy in end of 2022, and how much of that is actually demand growth. I think the picture is still pretty much mixed in China. I think Q3 is going to be a pivotal time for us to understand the Chinese economy with a much better sense, but there is a disconnection between fundamentals and sentiment. These indicators on the downside that are coming from China are increasing bearish sentiment within the market, and you have seen how most banks, including JP Morgan and Goldman Sachs, have started to reduce their expectations for oil price as well. So I think it's a wait and see kind of situation, especially on a Q3 this year, which is just a few weeks ago. A few weeks
away. Absolutely, we're already into Q3. Thanks very much, Sarah, for setting the scene there. Omar, hello. On that point of China and OPEC forecasts, I mean, the headlines at least have been that Saudi has now come out with its latest voluntary July cut just to push back sentiment in the market, push back this financial negativity, right? This trader activity, if you like, short activity. But, perhaps it is really concerned about Chinese growth, and that's why it continues to do these cuts. And that does contradict its reports, doesn't it? So where do you think OPEC thinking and Saudi thinking really is on the outlook for demand?
I think it's very much along the lines that you said in your introductory remarks. They have a price in mind, which is they want to keep it above 70, around $80. And the mistakes they've learned from the past are that they all have investments they want to make. In order to make those investments, they need to have some degree of price certainty. In the past, the mistake they made is that they let these things fly a little bit out of control, and we had everything from up to 120 down to $20, I think it was in the height of COVID. And so they're just trying to be a bit more proactive rather than reactive in terms of maintaining that price. So I don't think that there's anything inherently contradictory. I think, as I say, it's just more prudent proactivity, and it's helped by the fact that Saudi Arabia is doing fiscally significantly better than it was, say, 5 years ago, and as a consequence, it can afford to be more proactive and be more firm in its leadership.
Do you think that this announcement by Saudi, Omar, on the July cut, the latest one, has added certainty to the market, or the opposite?
I think it's added certainty because what the markets want. So you have the short-term factors affecting prices, but in the long run, the critical element that's been ignored, but that continues to play an important role, is the investment cycle. Saudi Arabia is trying to ignore these sort of short-run blips and is trying to engineer an environment where the price is conducive to sustained investments in the oil sector, and investments which are not just required on the part of oil producers, but as we saw in the wake of the Ukraine crisis, on the part of oil consumers. So what I would say is that it's added certainty because it's given markets the sense that Saudi Arabia is a reliable, is taking the bull by the horns, and it's not going to let things fly out of control. And I would also add to that the other factor you didn't mention, you mentioned in the introduction, but you didn't really dig deep into, is the US monetary policy. You said there's going to be threats of a mild recession in the West, and I agree with that. And the big uncertainty at the moment isn't just the stuff that Yasar was talking about regarding China, whether it's pent-up demand or versus. It's also US monetary policy. Is the Fed going to go on continue to raise rates, or in the moment it's looking like a holding pattern? But the question is, how much of it is it going to if it tightens, that's going to make it significantly worse. I don't think it's going to loosen, but monetary policy can be difficult to predict. And now we've got, in the coming year, an election, important presidential election, and the Fed has been notoriously politicized in the last 30, 40 years. It wouldn't be the first time they monetary policy in an attempt to help an incumbent. So that could be a factor that's playing on the market's minds too.
Okay, yeah, no, absolutely. And we had one of our speakers yesterday saying how he had underestimated, and I think he was making the point that everyone had underestimated the impact that the Fed policy is having directly on China, on the Chinese economy, on how consumers and how its exports are behaving, et cetera, and how much that ripple effect is going to have on manufacturing in China beyond what's happening domestically and with domestic policy. Kieran, just back to you on that. We mentioned diesel exports out of China up year on year in May, 4 times actually in the bulletin headline that we've got, which indicates a weak internal situation. Give us a picture of the diesel generally. Globally, the margins have been a little bit under pressure in the last few months. Gasoline, is that having a pickup because of US driving season, et cetera? Jet fuel expectations, where are we at with products?
Well, I would exercise a little bit of caution on that year-on-year China gas oil export number, because the corresponding export number this time last year was extremely low. So yes, 3-4 times, etc., like that, it is quite headline grabbing, but it was very, very low last year. I think also on that front, what we have seen in May and June is over 1.2 million tons per month leaving AG in West Coast India and pointing west on diesel. And so if you're saying, well, okay, it looks like high Chinese export number. Well, if that was having a softening impact on the market, then the East wouldn't need 1.2 million tons a month from the Middle East and India. So the picture doesn't look quite so bad in Asia, actually, on the diesel demand front. A little bit different, there undoubtedly there's been some refinery issues in Europe, Asia, Australia, that and a couple of hiccups in the Middle East, the cyclone in the Middle East impacting Indian exports over the last week or so as well. So there's been some refinery headlines that have impacted some of the numbers, but in general the diesel market actually looks okay east of Suez. Gasoline, as you say, it's coming into US driving season now, and it's taken a tick up. You're right, margins have cracks have been have obviously come some way off the highs in the last few months, but again in the last couple of weeks, refinery margins have actually ticked back up again, obviously helped a little bit by those OPEC cuts and sort of less crude around, and a bit of expectation that that crude market will be a touch tighter short term anyway. So yeah, the product market's largely looking okay. On the jet fuel side, it's still languishing versus 2019 levels, but only around 500,000 barrels per day, and that remains predominantly in the long haul sector out of China. I think, as Yasser alluded to there, that there's possibly a bit of pent up demand from COVID, and I think all the expectations are that we should see a good summer travel season, and that sort of jet fuel demand pick up again. Whether it picks up by 400,000 or 500,000 barrels per day is maybe arguable, but we are seeing, the closure or the reluctance of a lot of international airlines to use Russian airspace means longer routes, larger aviation fuel burn, etc., which is adding to the jet fuel market. So I think largely Mogas jet gas oil looks okay. I think naphtha is a bit concerning at the moment. We're seeing sort of reverse arbitrage out of the Red Sea rather than go east. Naphtha is pointing west. Petchem demand in North Asia isn't fantastic. So, and again, that would point to some economic headwinds, because it's usually a good indicator of economic performance, sort of naphtha demand for that petchem sector.
Okay, thanks, Kieran. So it sounds like it's sort of balanced overall. There's nothing too negative, and things are picking up on certain products. Yes, Sarah, just what evidence, let's go back to crude, away from products a little bit, and talk about any evidence we're seeing in the market now of the sort of OPEC cuts, the voluntary ones previously announced in the last cut, let's say not the most recent one, but the one before, the 1.6, and even the ones in October. I mean, are we now seeing those really filter through and settle in as evidence in the market? And let's also talk about Russian oil flows at the same time, which are not being cut from what I'm hearing. And we have a headline saying Russia's just raising its crude processing and everything's hunky-dory. So where's Russia versus other cuts and flows there in the market?
Thank you, Diala. Yeah, just to answer the first bit of your question by actually going back to the comments by I think India's economy minister, the ones that you had on your bulletin.
Yes.
So, but you look at the cuts, and just to also add to what Umar has said, which is defending the price of 70. I mean, the OPEC Plus cuts, all of them, whether they are the existing ones or the voluntary ones, they have not led to higher oil prices. They are barely defending the $70 per barrel price floor, let's say. And the oil prices are still largely affected by the bearish macroeconomic sentiment globally. And this is because of lower than expected demand recovery in almost all large economies. The market is also well supplied, given that Russia is an active player in it, despite sanctions, despite self-sanctioning, despite price caps, and not to mention resurgent oil production from non-OPEC members like the US, Brazil, and Guyana, for instance. So when you look at India, for instance, India and even China, they are very well supplied markets. And they are getting relatively less expensive oil, given the heightened imports of discounted Russian crude. So if India, for instance, some 80 to 90% of its demand comes from imports. Now, looking at Russia, you are absolutely right that Russia has created sensitivity within OPEC plus, you know, with the fact that it was the first to announce unilateral voluntary cuts in March, and this has led everyone else to come up with voluntary cuts, and now there is a problem when it comes to Russia adhering to these cuts. Now, Russia must achieve with the voluntary cuts because to be accurate, the Russians are implementing the original cuts. You know, when you look at the OPEC 13 June communique on changing Russia's target, oil production in May stood around 500,000 barrels away from or lower than the February 23 level, according to the secondary sources. So they are implementing the original cut, but not the voluntary one. But anyway, Russia has a very thin balance to maintain, a very tricky balance. On one end, the conflict in Ukraine dictates, and of course its overall dependence on energy export revenues, it dictates that it maximizes the returns on its already heavily discounted oil. On the other, it doesn't want to risk being left out from OPEC plus, and OPEC plus is the undisputed supply manager in the market. And by the end of the day, this is one of the few multilateral organizations that continue to welcome Moscow on board. So Russia also understands that it cannot unilaterally impose fundamental changes to the market anymore, given its situation. So Moscow will have to become a team player. Of course, this is incentivized by the common aim of keeping prices afloat. And you can see some changes to the Russian policy. So they have decided to become more transparent with OPEC plus secondary sources, and that has helped them to get a better required production target for 2024. But again, you know, the reality is Russia is winning on the loss of other OPEC plus members. So you look at China and India in June and July, Russia's market share is going to increase. Why? Because of the Saudi lollipop, because of higher OSPs by Aramco and others, which basically are telling you know, Asian customers to take less crude. And Russia is going to capitalize on that. But you know, this is a very sensitive and tricky balance for everyone involved.
Thanks, Yasar. Yeah, and Omar, on that point, I mean, Russia is taking advantage. It has its priority is its war, its revenue, and it's doing whatever it wants, basically. But it still wants to remain, obviously, within OPEC plus. it needs to be in OPEC plus, but actually Saudi needs Russia in there more than anything, doesn't it? Because if Russia starts misbehaving, then, you know, we could see a repetition of previous problems. And we, you know, is Saudi willing to do whatever it takes to keep Russia happy, basically?
Well, so I would say that, you know, Russia, first of all, Russia has been historic. I mean, Isar mentioned it supposed to be a team player. They've traditionally been team players only insofar as their technical production limitations actually make them adhere to their quotas rather than any sort of actual voluntary cuts. And they have a long history, as you mentioned, Diala, of you know, violating quotas sometimes quite egregiously. In terms of who needs whom more, I would say actually it's more symmetric than you might suggest, because, you know, Russia's is quite isolated diplomatically at the moment. While it has, you know, some big friends like India and China, it also has a lot of enemies, and it certainly doesn't want to add Saudi Arabia to the list of disgruntled, you know, international partners. But by the same token, as you said, Saudi Arabia, you know, oil strategy, it relies on maintaining some degree of price stability, and that price stability requires at least 2 of the world's 3 biggest oil producers to be in part of the club. I mean, the US isn't going to be part of it, but at least Russia and Saudi Arabia need to be. If it's just Saudi Arabia, then obviously it's just going to be the worst possible attempt at maintaining, you know, price stability. I would also add that, you know, the question, the nuclear deal with Iran is sort of lurking in the background, because we've got question marks over what's going to happen with Iranian oil once sanctions are lifted, if and when they're lifted. And there's also, you know, this sort of political rebalancing in the Middle East, which is affecting the calculus of Russia vis-a-vis Saudi Arabia, and, you know, and vice versa. So it is a bit of a geopolitical mess, not for the first time and probably not for the last time, which is making all this analysis quite difficult. And I guess in the coming few weeks, it looks like we're getting some. The latest is we're going to get a new deal now with Iran and USA, although I saw the Republicans are groaning about you know, that having to go with Congress. So it's difficult to we're waiting for a few key decisions which may give us a bit more clarity, whether it's the Fed or the US State Department.
Well, I mean, the US Iran thing is interesting, because many people have said, yes, there's all these murmurings of a deal coming back to the fore, and yet there's no way. Other people say no way anyone will do a deal, both sides, because you've got an election coming up, you're going to have a change of president, and then what does that mean for Iran and for the US? So it's fun. It's interesting that it's all sort of coming to the fore now, when it would be the least likely period of time that you would have expected this deal to have a sort of rebirth, if you like, or at least the talks around it. Let's just, before I go to Kieran, let me look at that survey questions on China, which we started with in terms of, you know, Chinese demand and how that's influencing the market. Too little, too late. Post-COVID stimulus won't trigger sufficient oil demand recovery in the second half to absorb the growing supply from Russia, US, Iran, and others. Do you agree or disagree? Kieran, I mean, we did have some headlines in the news in the last week saying that there is this, apart from the first half expectations of China, even this week, last week, we were expecting the government to come forth with more stimulus measures for the domestic economy, and that's not coming forward as quickly as some people expected. I mean, how much is the market, do you think, relying on that? I mean, is that really the only thing that's going to, OPEC policy is one thing on cuts and supply, but really what we need is this Chinese resurgence in demand. And without that, anything OPEC does really doesn't make a difference.
Certainly the market needs it. It's to what degree does it need it? You know, some of the heavy industry data coming out of China, particularly in the construction sector, is, you know, does merit some attention. It's a little bit concerning. The mobility data, though, isn't too bad, Diana. And I think we are going into a season, as I said earlier, where, you know, it's holiday season. Even you spoke earlier in the podcast a little bit about the expectations of a soft recession. I think even in the West, it does feel like majority of people aren't going to give up their summer holiday, despite, you know, what they're seeing on the news, what they're feeling because of inflation, etc., like that. I think consumer spending is still quite good. So I think this sort of summer travel season is key in the West. OPEC Plus and what they do in terms of supply is key. But yes, there's so much expectation and so much focus on Chinese recovery. I think it's hugely significant, and hence why it's getting so much attention. But data remains a little bit opaque, right? So hence why there's so much focus on tracking on exports on the product side and imports on the crude side.
We had Kieran, just sticking with you on sort of China, but demand also for LNG, just to get your take on what the expectation is for that. I mean, and in the context of summer season coming up, heat wave season coming up, and yesterday we had an interview actually, which is coming up, will be coming up tomorrow, with Dr. Anas Al-Hajji, when he was saying that this, fuel substitution pattern that we began to see in 2022 has dissipated a bit. But again, that's something that's here to stay, i.e. switching to coal from this and that, because of this imbalanced market. Would you agree with that we're going to continue to see fuel switching to the degree that we may have seen last year, if there's certain triggers to that?
Largely it's price driven, I would say. It was certainly, well, you could say it was price driven last year, but there was the elements of self-sanctioning around Russian crude, etc. Was to an element, to a degree, it was enforced in some countries, like Germany, etc. But I think what it has done is it's economies like China. It means that they have to mix up the sort of energy slate between gas, coal, petroleum, etc. like that. So yeah, I think it really depends on the geography, and it's no surprise to see China sort of investing more in its LNG import logistics, and therefore its capabilities, and it has the buying power. There is that. I think it's the FT reporting this morning a large deal between Qatar and China. But the majority of Qatari LNG obviously does go east as well. So again, it's a sort of geographical thing. But no surprise post that Russian invasion of Ukraine and what it did to the oil markets, that countries largely sort of mixing up their import requirements so that they're not wholly reliant on the oil sector.
Yeah. Omar, just to go back to you, another headline we have with Qatar today on the bulletin is UAE and Qatar restoring diplomatic ties. I actually thought they had done that. I'm behind the times. That's with Saudi, actually. But I mean, the feeling is they have anyway, for all intents and purposes already. But so what significance do you think that has? That's just another sort of layer to the cake that we're seeing this year.
I think that when it comes to Saudi, Bahrain and UAE, the most important, restoring ties with Qatar, I think the most important step was Qatar restoring ties with Saudi Arabia. Once that happened, it was just a case of administrative delays to get that overdone. They've done that, and now what we have is the foundation for a series of Middle Eastern relationships that looks like very different to what it might have been 5 years ago. Many are saying this is like a new dawn. I'm perhaps not quite as optimistic at the level of the entire Middle East that this is going to be a new dawn as much as others are convinced. But certainly we have the foundations, and now we have Iran being integrated, potentially having relations with countries that it has not had relations with recently. Israel, obviously, in the wake of the Abraham Accords. So, what this new configuration is going to be like is interesting. And, given the context here, it also impacts energy markets, as we mentioned, because of things like the Iran deal and Iran's oil production, but also because, historically, instability in the Middle East and conflict in the Middle East has been a driver of oil price spikes and general aversion to engaging with the region. So, but in the large scheme of things, this specific bilateral relation, I don't think is any particular significance to the way things are going. It's more just a manifestation of the general restructuring that's happening in relations in the region.
Certainly, a lot of that going on. There's our survey result for today. Agree, 69% think that China's sort of stimulus program is a little bit too little too late. 31% disagree. A lot of people saying this is just a normal recovery, just like Europe recovered, America recovered from COVID. So we're putting too much expectation on Chinese policy. Yasar, just to go to you very quickly, I'll give you a minute to respond. Just wanted to get your thoughts on, we have a couple of headlines also on Kuwait forming a new government, having a new oil minister, but I don't really want to get into that, except just to address, where do you think Kuwait and Iraqi production targets are at today? We've seen a bit of a recovery this year, a good bit of positive news, but again, sort of any expectations there for the remainder of the year that's going to make a difference to the market?
So just to take these two issues separately, so Kuwait, we always have hopes of economic reform renewing every time Kuwait has a new government, but what really persists is the political dysfunction, unfortunately, stemming from all of these historic competitions between the legislative and executive branches of government. Now, but the new cabinet is perhaps PM Ahmed al-Nawaf's boldest cabinet yet, especially the return of Ahmed al-Fahd to the political arena and so on. We have a businessman taking over the oil ministry, but in reality, unless we have economic reforms, doing something about all of that welfare spending that usually pressures KPC and its companies to slash their budgets, that is going to be problematic. And Kuwait needs to spend a lot on its energy sector, not just on the oil side where they have to reverse declines and increase capacity, but also on power generation. Power capacity has stagnated, and that is a problematic. Kuwait might end up importing electricity going forward, emergency supplies from the GCC-IA interconnector. Iraq, well, the big thing is the KRG and resumption of Ceyhan exports. There is a delegation from the Turkish side which arrived in Baghdad, I think, this week. These talks are going to be protracted. Ankara, what they want is to negotiate the ICC 1.47 billion award. They want other cases filed to be withdrawn. At the same time, Baghdad is in no hurry to see Ceyhan exports resumed due to the fact that they are maximizing their southern oil exports. They have added around 113,000 barrels per day in April and May, which is more than what SOMA usually sends via Kirkuk. The most important part of all of this is that Baghdad now is in full control of all oil flows through the Kurdistan region. Kurdistan has lost over 2 billion in revenues since the stoppage. Baghdad has full control of all oil flows. Erbil has just some token optics of management of the oil sector. Its hopes of economic independence have ended. This stoppage might continue for a bit longer, but Baghdad is incentivized politically to subsidize and pay money to the KRG. Meanwhile, simply for the fact that the Sudani government needs to stay in power, and they need the ruling Kurdistan Democratic Party to do that. So,
okay, yes, sir, I'm going to have to stop you there. We could go on for much longer if we start talking about Turkey and Iraq and Kurdistan. But thank you so much for your insight, Yasar Al-Malki, Kieran Gallagher, thanks, and Anwar Abaidly. Thank you so much, gentlemen, for joining us today, and have a great week. Thank you.
Thank you very much. Bye.